Ryan Reynolds here for, I guess, my 100th Mint commercial. No, don't. I mean, honestly, when I started this, I thought I only have to do like 4 of these. I mean, it's unlimited premium wireless for $15 a month. How are there still people paying 2 or 3 times that much? I'm sorry, I shouldn't be victim blaming here. Give it a try at mintmobile.com/save. Whenever you're ready.
$45 upfront payment equivalent to $15 per month. New customers on first 3-month plan only. Taxes and fees extra. Speed slower above 40 gigabytes. See details.
This episode is brought to you by Ring cameras and doorbells. A lot happens while you're away from home. That's why Ring makes it easy to check in from anywhere. Whether you're saying hi to an unexpected guest, making sure those packages are safe, or keeping your pets company while you're out grabbing groceries. It's all a few taps away, right from your phone. Be there with Ring. Explore cameras, doorbells, alarm kits, and more right now at ring.com.
Hey guys, Akil Stokes here. Welcome back to the Trading Coach Podcast. Today, I have got an amazing session in store for you, a trading masterclass by Jason Graystone, where he's going to teach you about the laws of probability, the laws of large numbers, and pretty much having an understanding of how a trading edge really works. This conversation comes from a recent workshop that we put on called Beat the House, where we took a look at trading and compared it to gambling and how, the two kind of are very similar for both positive and negative qualities. If you missed it, I apologize, but we do these type of workshops usually twice a year, so make sure you stay in the loop. That way you don't miss the next one, all right? Hope you enjoy. Let's hop in.
In this session, what I want to do is wake your brain up. I want to share some insights, some valuable exercises that will tell me a lot about you and if you have what it takes to be a great trader. So what I'm going to go through now will literally, I'll be able to filter out who's made for this and who isn't. Don't believe me? Let's get stuck in. Who understands basic probability? Honestly. We're talking about, we're talking about gambling, we're talking about casinos, we're talking about trading. Probability, write this down, it's simply the likeliness of a random event occurring. That's basic probability, okay? And in order to fully understand probability models in trading, it's very important that you know how to calculate the basic probability of a random event. Who knows how to calculate the basic probability of a random event? I'm going to give you tools to do this. Okay, so for the example I want to give you, I want to calculate the probability of flipping a head in a single coin toss. Who knows the probability of flipping a coin and what the coin will land on? Fire it in the chat. 50-50, 50-50, right. So the probability of any event, okay, equals the number of ways the event can occur divided by the total number of possible outcomes, right? So the probability of flipping heads is flipping a head divided by total number of outcomes, heads or tails. So when you put that into a mathematical formula, it is 1 divided by 2. Make sense? Very, very simple. That is basic probability 101, 50-50, coin toss, flip. Very, very easy. Very simple. So the probability of any event occurring has a value between 0 and 1. 0 represents an impossible outcome, and 1 represents a certain outcome. Right? And then to quickly turn decimals into a percentage probability, you simply multiply it by 100. Okay? So in the example above, we've calculated the probability of flipping a head in a single coin toss is 0.5 or 50%. Right? Now, let's take that previous example. This is going to be very relevant to trading. Okay? And it's all going to start, you're going to have aha moments. It's going to blow your mind. Right? So let's take the previous example of a single coin toss, and let's throw some money into the mix, right? Let's throw some money into the mix. In fact, let's get Akil's money. Right? Let's just say you got a friend called Akil, like me. And Akil's willing to pay you $1 every time you manage to flip heads, right? And in return, you have to pay him $1 every time you flip tails. How much money can you expect to make? Does anyone know the answer to that question? I'm sure you probably already know the answer, right? But when the random event becomes more intricate, right, as with trading and business, you'll need a repeatable, concrete formula to help you calculate your expected value or your profit expectation, okay? So first of all, let's summarize what we know about the coin toss. Who's intrigued by this, by the way? Has this got the old endorphins going? It's gripping, right? Okay, so there's two possible outcomes, heads or tails. We've previously calculated the probability of either outcome to be 50%. If you flip heads, you make $1. If you flip tails, you lose $1. Okay? So with that information that's on the screen, we can now use a profit expectation formula to calculate exactly how much profit we should have or we should expect to make from Akil, because he's our opponent. Okay, so write this down. Profit expectation equals the profit scenario plus loss scenario. So in this, broken down, it would be profit expectation equals profit times probability of profit plus loss times probability of loss. Profit expectation 0. So all of you guys, I think most of you guys got the answer to that question right. Because from a mathematical standpoint, your expected profit in this situation is 0, right? But you already knew that would be the case. So what we're going to do is we're going to skew the numbers now, and we're going to see if we can make money from a coin toss. Who thinks we can make money from a coin toss? Does anyone know how you would make money? Exactly, right. So we're getting somewhere. So this time what you do is you negotiate with Akil and you come to an agreement that if you flip heads, he still pays you $1. But if you flip tails, you've only got to pay him 90 cents. And that 10-cent difference can be a game changer. So after negotiating with Akil, you've now got a profit expectancy of 5 cents per coin flip. If you toss the coin 100 times, statistically speaking, you'll make $5. And by cutting your losses short, who's heard that phrase, by the way? Cutting your losses short. If you cut your losses short, you manage to gain a profitable edge in the game. Now in trading, one of the ways that we achieve that edge in the market is by cutting our losses short. And we do that using trailing stops and things like that and stop losses, which we'll talk about in more detail as the workshop goes on. But does everyone understand that so far? Great. So what is an edge? Does anyone know what an edge is? I'm going to be asking you guys a lot of questions, and there's a reason for that. If you've been to any of our events, we filter out a lot of riffraff early on. People usually leave who are not interested in learning what you need to learn to become a profitable trader. So we try and filter those out early on, and this is all part of that process. If you're interested in this, well done. You've got half a chance. Beating the odds, right? So having an edge in the market is simply like having a positive profit expectancy. That's it, right? A trader with an edge will make money over time as long as they give the edge long enough time to play out. Make sense? And there's 4 core methods that we can use as traders to increase our edge. So take note of these, right? The first one is increase your win rate, right? This is how we beat the casino, by the way, guys. This is how you beat the house. First one, increase win rate. Second one, decrease loss rate. Third one, increase profit on winning trades. Fourth one, decrease losses on losing trades. Okay, so in other words, you want to win more than you lose in terms of you're right more than you're wrong. and you want to win more on the winning trades than you lose on the losing trades. I know that sounds very, very obvious, but does everyone understand that they are 4 separate things that you can increase and work on to develop an edge and refine an edge? Because edges in the market are very small. Edges everywhere in business and everywhere in life are very, very small. I'm going to prove that to you in just a moment. So we must exploit all of these things. Okay, there's a saying in the financial markets, cut your losses short, let your profits run. Who's heard it? It refers specifically to, points 3 and 4 on your screen there. And that helps traders increase their edge. So a powerful trading strategy, which we're going to go through a bit tomorrow, with stringent risk management procedures, should use all 4 of these methods in order to increase your edge in the market. So here's a question for you guys, right? If all you need to do to make money is to follow a good strategy, then why doesn't everyone make money trading? Anyone? Brings me to my next point, which is risk preference, right? Now, one of the reasons that people find it so difficult to stick to their trading strategy is because the human mind is not wired to think in terms of probability. Instead, what it's designed to think of is in terms of survival and self-preservation. It is literally basic human nature to prefer immediate gratification over delayed gratification, right? But the problem with that is, if you employ those instincts in the market, that is a sure way to lose your money. That is when you become a gambler. That is when you're using emotion to trade, and the only logical part of your brain you're using is to give you logical reasoning as to why you emotionally got involved in that gamble or that trade. Who's lost money in gambling before and then tried to make it back, or tried to persuade themselves that why they should be getting into a bet or a gamble right? So your emotion's driving it, and then your logic is trying to back up your emotion, which is that's not the right way to do it, right? So let me demonstrate this to you with a bit of a survey, okay? Here's a question for you guys. Would you prefer a definite gain of $700, a sure gain of $700, or a 75% chance of gaining 1,000 and a 25% chance of gaining nothing? We've got mixed, see? We've got mixed people here, right? A for sure, A, B, 700, A. Right. I can tell you that on this actual survey, 84% of people chose option A because they tend to be risk avoiding when it comes to gains, preferring to hold on to the, bird in the hand, right? Once they have something, they're violently opposed to risk losing it. Sound familiar? Now, let's try another one. Would you prefer a sure loss of $700 or a 75% chance of losing $1,000 and a 25% chance of losing nothing? D, right? So this is, it's still majority D. 87% of people chose D because they tend to be risk-seeking when it comes to losses, right? They'd rather risk a possible big loss in preference to suffering a certain moderate loss. And this is how gamblers get hooked. Once they've made a loss, they keep gambling, sometimes even bigger stakes, larger stakes, because they're trying to avoid realizing a loss. Does that make sense? So they keep gambling so that they feel like they're still in the game, even though they're losing money. So it becomes irrational. Because they're still gambling money, they still haven't given up, quote unquote, which means they're not losing in their head. Does that make sense to everyone? It's crazy, right? It's irrational, completely irrational. But that's what happens. That's what an addiction is. Now you know how to calculate probabilities. You'll find that options B and C here, all right, the two middle ones, they are mathematically better decisions. But the hard part, specifically in this example, is retraining your subconscious mind to recognize that that is better decisions and then start taking actions in line with probability. Because it goes against how you're built as a human. Naturally, this comes with like time and experience, right? And these principles that I'm sharing here, they're not exclusive to trading. In fact, many successful entrepreneurs and businesses use this structured thought process in their decision-making processes every day. I'm sure there's great entrepreneurs in here who have done exactly that. Cool. Was that valuable so far? We're going to talk about luck now. We're basically ironing out everything to do with probability and edge development at an early stage so that you guys have got real clarity and focus and determination to succeed on this. If I can give you confidence at an early stage of this workshop, by the end of it, you're going to take in the information with an open mind, you're going to have an objective mind, and you're going to be able to develop on what we teach you rather than, you know, have your finger in the sky. Okay? Now, what if I just get lucky? Who's asked that question? Who's wondered that about their own trading? What if I was just lucky? What if I just get lucky? Let's look at that game, the coin tossing game of Akil, right? In the second game, remember you made an agreement with him that if he flips heads, he's got to pay you $1. But if he flips tails, you have to pay him 90 cents. And with the profit expectation formula that I gave you, he was able to calculate that you've got a profitable edge of 5 cents per flip over time. So you've got a proven edge. You're guaranteed to make money now, right? Well, not entirely. Because there's one thing that you didn't discuss with Akil, which could make that wrong. Does anyone know what that is? How many? Yes. How many games? What you didn't discuss with Akil is how many games. And I know he's a sneaky one. He will know this. And I've heard him. He goes to the casino and he stops playing at a certain point. So he's sitting there thinking, yeah, this is good. I'll agree to this, but I'm going to play 10 games and that's it. Or if it starts going in my favor, he just knows when to quit. Right? So let's say that you begin the game by flipping 3 tails in a row, which is a perfectly realistic scenario, by the way. Akil's now had 3 wins in a row, and then he decides to take his $2.70 and walk away. So in that example, we've played a game with a proven mathematical edge, yet still lost money. Does that make sense? Are you starting to see how most traders just don't have, like, why they don't make money? Because I've just been through a few little bits here that all make up a trader's edge, and most traders aren't even thinking about any of this stuff. Right? I'll tell you what they are doing. They're getting lucky, if anything. So this is what traders do all the time. They lose money. This is why they lose money. They've got a great strategy with a strong profit expectancy, but they quit, walk away, or they change their strategy before the edge has a chance to play out, and that's it. You can get lucky and you can fool the numbers in the short term, but over time and distance, your true profit expectancy will always work through. Okay? We've all heard of those people that win big on the lottery or on the slot machines or casino tables, right? They've all have a negative profit expectancy playing those games. But like Akil, in the scenario that I just gave you, got lucky in the short term and cashed out before their negative profit expectancy had even had a chance to work. So in trading, never ever confuse luck with skill and probability. That's something to write down. In trading, never confuse luck with skill and probability. There's a story. I went to Vegas recently and we were going to shoot some content for this very event. And we took out $100 and we were willing to lose the $100 for the sake of preparing some promo footage for this event. And this is a prime example. I had no idea what I was doing. We put it in the blackjack fruit machine thing. And I put it in and I couldn't lose. We ended up walking out with $500. We actually gave it to the guy, the room service guy. He couldn't believe it. But I couldn't even lose. That was pure luck. I had no idea what I was doing. But had that carried on, I certainly would have lost all that money. But what did I do? I cashed out early and I walked away. Not because I had a statistical edge, because I just didn't know what the hell I was doing. And I got lucky. It was true luck, right? So, serious note, how can you ensure that your profitable edge always works through? I'm going to tell you right now. It's by understanding the law of large numbers. The only way that you can ensure that your edge plays out over time is to keep applying that edge over and over again. You've heard me and Akil say this so many times. The law of large numbers is a theory, right? And it basically describes the results of performing the same trial a large number of times, whatever a large number might be, relative to what it is, okay? Now, according to the law, the average result of the trials should be close to the expected value or profit expectancy, and will tend to become closer as more trials are performed. Has anyone heard me talk about dollar cost averaging, long-term investing? Right. You invest, the market crashes. Next month, it's crashing. The next month, it's crashing. The next month, it goes up a bit, right? Then you have a big, 5 years later, it has a big boom. The next year, it crashes again, right? Then you have a recession. And then you have a massive boom. And guess what? Because you keep buying the market every single month, what do? Over a long period of time, you approximate the mean growth of that market, which is S&P 500 case, 8 to 10% per year, right? You play it over a long period of time. So in other words, if you've got a mathematical edge and a proven profit expectancy in any activity or any business or any venture or any game, it is in your best interest to play it over and over and over and over and over again. Does that make sense? This is what, and look, tattoo this on your head. This is what most traders can't do. Most traders can't do this. Don't believe me? This is the survey results. Consistency. There you go. Top answer, they can't do it over and over and over again. It's not just me, it's not my thoughts, not my opinions, this isn't what I think, this is results from asking people.
Hope you enjoyed, hope you took notes. Now, before you put your digital pencil away, do me a favor, keep it out. Take a minute or so to leave this podcast a rating or a review. It is the best way to support what I'm doing here. Moving up the rankings is one of the top trading-based podcasts out there, and I can only keep moving up with your help. So if you like the Trading Coach podcast, if you ever found value from any of these episodes, pay it back by simply leaving me a rating and or review and sharing it with your community if you want to do that as well. All right, until next time, plan your trade, trade your plan. Take care.